Fed's rate hikes are front and center as financial regulators figure out how to manage the fallout of the Silicon Valley Bank failure. Goldman Sachs said yesterday that it expects the central bank to halt rate hikes. Joining us right now is former Fed Vice Chairman Roger Ferguson. He's the former president and CEO of TIAA and now a distinguished fellow for international economics with the Council on Foreign Relations. He's also, of course, a CNBC contributor. And Roger, let me just ask, the measures that have been taken by the Fed and by Treasury, but are these enough to stem concerns about other banks at this point?
Well, obviously, time will tell. I certainly hope they are enough to stem concerns. And the one I find most interesting is basically the easing of some of the terms around the discount window through this special new bank term facility. The fact that the Fed is willing to basically take as collateral the good, relatively riskless assets that banks hold and provide liquidity should give everyone a great deal of comfort. I mean, it really does say the Fed is ready to provide liquidity to banks that are in good shape. And that, I think, I hope, is sufficient to give the kind of comfort that's called for.
I sure hope so, too. But let me raise the question. Depositors are safe. Their funds are safe. Shareholders and bondholders, not the case. So any of these stocks that have already been under pressure, some of these banking stocks down double digits, and not low double digits for many of them. Look, even one of the banks that we were watching today, First Republic, watching through with that, even though it's been given extra cash from both J.P. Morgan and from the Fed, that stock's still down by more than 50% today. So what does that tell you? If you're someone who's a shareholder and you're not going to be bailed out and the stock continues to decline, if you have money there as a depositor, sure, it may be insured, but it may be kind of a pain to go through some of these things. You might be pulling your money otherwise. I just wonder if that happens other places. And by the way, First Republic Bank is now down 73% this morning.
So, look, I think it says a number of things. One is the obvious, which is there's stress in the system. That stress should be shown through the equity valuations because, in fact, equity is the first thing that will be wiped out in one of these resolutions. And it's the opposite of a bailout in that sense. I think that word bailout is inappropriate here. Yes, with respect to depositors, there will be a process for those that are in the uninsured category, which I think will slow things down, but meant to be, I think, as quick as possible. Because the other point that we should make here is many of these depositors, as with one of your early guests, are basically running small and medium-sized businesses. They're startups with a few dozen, maybe, people on the payroll, so we shouldn't think of these as all large and sophisticated. So the system is under stress. Yes, that is obviously the case. I think it will take a little while, maybe a couple of days, for all of this to settle down, for individuals to realize that capital is pouring in, to also realize that many of these banks have now an asset that's worth 100 on the dollar, and that's really very, very important here. And finally, I think everyone has learned that these bank runs are driven by people panicking. And indeed, if deposits are safe where they are, then I think the government is trying to get people to keep their deposits where they are. Will that work? Only time will tell.